Hello, everyone. This is Jillian Verdun from JMV Financial Services, your profit strategist, bringing tips and tricks to improve your financial situation for the new year. Thank you again for tuning in and listening to us today. We're going to talk about what you need to contribute before the year runs out. With the holiday festives just around the corner and only a few days left before we finally call 2021 a wrap, it's so easy to get carried away and regulate matters of our finances for later. However, to remain on track as well as a plan for the upcoming year, there's no better time to get your financial ball rolling for 2022 than now. You want to use the few last weeks to revisit your financial goals. Find ways to maximize your financial health and make critical money moves for the forthcoming year. Today, we're going to identify smart money moves to make before the year ends. Before you go on, evaluate your investments. It's expedite to check in if your investments are profitable or running at a loss. You can do this by running an audit on your investment portfolios, especially when it's beyond retirement accounts. You can start by realigning your portfolio based on those that have more gains and losses. For instance, if your asset allocation is 60% bonds and 40% shares, the profit and losses in each one can help you rebalance them back. You can sell off the ones that have a higher dividend to add up to the ones that has losses. Moreover, you can also adopt the tax loss harvesting method, where you sell off your investments on loss to reinvest in a new market. For this to be successful, you need to be aware of the following. Short-term gains. This is profit made in a sale of less than 1 year. Their tax margins are high, so you need to aim at reducing them. When harvesting losses, do not interfere with your long-term investment plans. A wash sale disallows the tax loss deduction, so always check the wash sale rule before and after making a loss sale. The IRS considers a security a wash sale when a new substantial identical security is purchased within 30 days after selling off a security at a loss. Consult your financial advisors on the best tax harvest strategy to make. What you should contribute to before the end of the year. Number 1, max your retirement accounts. Catch up with your retirement plans by doing what you can to max out your contributions. Maxing out your retirement contributions, whether your traditional plan or Roth option, is a smart money move that will position you for future success down the line. Since 401k contributions are paid with pre-tax income, your monthly salary drops with each pay period, meaning that you get to pay less in both federal and state taxes, if applicable. In essence, you're giving the government less and paying yourself more each month, although you can't withdraw those funds until you're up to age 59 and a half. And in that time, you're also giving your funds time to grow and compound. Contributing to your Roth IRA does not reduce your taxable income. However, accumulating as much as you can before retirement is one of the best investments you'll give yourself. Depositing a higher contribution to your 401k or IRA before the end of the year not only lowers your taxable income, it also has the added benefit of maximizing your savings and, in turn, your overall financial health. Number 2, max out your HSA, health savings account. Individuals with high deductible health plans can use a health savings account to save money for qualifying medical expenses tax-free. You can also use the money tax-free. The main benefit here is the tax savings. With an HSA account, you can save money for future medical expenses without fearing the use it or lose it policy of an FSA, which we'll talk about in a minute. Plus, distributions for qualifying health expenses are tax-free and contributions are tax deductible. Because HSAs roll over from year to year, taking your year-end bonuses and putting them directly into your HSA is a smart way to reduce your taxable income while growing the account. Number 3, use up your flexible spending accounts, which is your FSA. Have you heard of the FSA use it or lose it rule? Unlike health savings accounts, FSA's funds do not roll over if they are not used up. Of course, the money doesn't just disappear. It is reimbursed back to your employer. If you have been committed to contributing to your FSA, then you should try to use it up. Otherwise, you'll lose all of your contributions. You should know the conditions backing up your employer's FSA plan so as to determine if you have a rollover or use it all option. When your FSA has a carryover policy, you can choose to roll over any unused balance into the next year. You may be allowed to carry over up to $500 in a health FSA to spend in the following year if your FSA has a carryover policy. Your employer may also give you a 2.5-month grace period to spend any leftover funds in your FSA. However, a standard issued healthcare FSA plan makes no provisions for these reliefs. And so the use it all or lose it rule is in effect. Your FSA funds may also be used to purchase other medical products and not just medical bills. Therefore, you can use it to stock up things that could be benefit to you in the future. Number 4, fund your child's education with a 529 plan. Another fund which you can contribute to before the year runs out is a 529 plan. A 529 contribution plan allows you a free federal tax deduction as long as it is used towards educational expenses. As much as there is no maximum contribution per limit per year, the IRS is against contributing more than $14,000 for the beneficiary, as doing so could lead to a gift tax. You're also not limited by using your state's 529 plan if you believe another state's plan is better. Number 5, donate to charitable organizations. What better time to give than in this festive season? Donating to your favorite charitable organizations can benefit you in your income tax deductions as long as you donate to an organization with a 501c3 status. All donations given to such organizations are classified tax exempt by the IRS. Check to confirm that your gifts are going to a legitimate charity organization before sending them. And you can check this with the sites like GuideStar, Charity Navigator, and GiveWell. Bottom line, make the most of these last days by contributing to accounts and maximizing your returns going forward. Again, thank you for listening to us today, and please follow us on your favorite podcast. Bye.